Two drivers. Same city, same car, same clean record. Neither has ever filed a claim. One of them pays about $900 a year more than the other, and the reason has nothing to do with driving. It is a number. Neither of them has ever seen it. Neither of them is allowed to. The number has a name. It is called a credit-based insurance score, and in most of the United States, it is one of the largest single factors in what your car insurance costs. Almost every insurer in the country uses one. Almost no driver knows it exists. By the end of this, you will know exactly how it is built, where it came from, and why the industry cannot explain it. Start with what it is not. It is not your credit score. Not the one your banking app shows you. Not the one you check before a mortgage. Your credit score is built to predict one thing: whether you will pay back money you borrow. This score is built from the same file, the same accounts, the same payment history, and it is weighted to predict something completely different: whether you will crash your car. Two numbers. One source. And you are entitled to see exactly one of them. In the early 1990s, Fair Isaac, the company behind the credit score you already know, built a second one. Same raw material. Different question. Instead of asking who repays debt, it asked who files claims. Insurers started buying it almost immediately, and here's the part that matters: they did it quietly. There was no announcement, no line on your bill, no regulation because nobody had written any yet. Through the entire decade, the price of insuring an American car was quietly being reordered by a number that was never disclosed to the person paying it. It took about 10 years for Washington to notice. In 2003, Congress passed the Fair and Accurate Credit Transactions Act, and buried inside it at Section 215 was an instruction. The Federal Trade Commission was told to go find out what these scores actually were and what they were doing to American consumers. The FTC took 4 years. It reported back in July of 2007, and the answer it came back with was not the one either side wanted. Here is what the score does to a price. Take the most recent national data from February of this year, an analysis of over 250 million insurance quotes. A driver with excellent credit and a clean record pays about $1,968 a year for full coverage. Same driver, same record, poor credit, $2,760. $792 every year for a credit file. Now you will see much bigger numbers than that quoted. You will see studies saying poor credit doubles your premium. Those studies exist, and they are not wrong. And the reason they disagree is worth understanding, because it tells you how this is priced. Some studies measure full coverage. Some measure state minimum coverage only, where the base premium is small, so the same dollar penalty looks like a much bigger percentage. Some use quoted rates, some use filed rates. Some draw the line between good and poor credit in a different place. Depending on which you read, the penalty is 40% or 98% or 115%. The honest answer is that it is somewhere in that range, and where you land depends on your state more than almost anything else. In New York, the gap runs about 70%. In California, it is 20%, because California has banned the practice, and what is left is the residue of other factors. Which brings up the part almost nobody knows. 4 states ban this outright: California, Hawaii, Massachusetts, Michigan. 3 more restrict it: Maryland, Oregon, and Utah. Each in a different way, each with a different loophole. In the other 43, the number is doing its work right now on your policy, and it is legal, and it is invisible. So what is actually inside this number? Payment history. How long your accounts have been open. How much of your available credit you're currently using. How many new accounts you have opened recently. Whether anything has ever gone to collections. Broadly, the same raw material as a credit score, weighted differently. And now notice what is not in there. Your income is not in there. The score does not know what you earn. It does not know whether you have savings. It does not know whether the late payment happened because you were careless or because you were in a hospital bed. Here is the part that catches people out. Opening a store card for a one-time discount moves it. Closing an old account you no longer use moves it. Carrying a balance in a month when you were between jobs moves it. Every one of those is a decision about borrowing. Not one of them is a decision about driving. So how much is a credit file actually worth in risk terms compared to the things insurance is supposedly about? In 2023, the Consumer Federation of America ran the comparison directly. Looking at state minimum coverage, they found that a driver with a spotless record and poor credit was paying more than a driver with a conviction for driving under the influence. Hold that. Not a speeding ticket, not a fender bender, a DUI. Under that study, on that coverage, the credit file outweighed the drunk driving conviction. Now, the Consumer Federation is an advocacy organization. It used minimum coverage, and that is the pricing basis where percentages swing hardest. So take it as what it is. But the direction is not in dispute, and the direction is the point. In the pricing model that decides what you pay, a late payment on a store card 3 years ago can matter more than what you did behind the wheel. There is one more finding in that FTC report, and it gets misquoted constantly in both directions, so let me give you both halves of it. First half. The scores do not fall evenly. African American and Hispanic consumers are heavily overrepresented among the lowest scores and heavily underrepresented among the highest. Running the system raised predicted risk by about 10% for African Americans and just over 4% for Hispanics, while lowering it for non-Hispanic white and Asian consumers. Second half. The FTC also concluded that the scores do not appear to be working as a stand-in for race. The measured proxy effect was around 1 percentage point. Those are two different findings, and you need both. A disparate outcome is not the same thing as a variable secretly encoding race. The FTC found the first one, and specifically did not find the second. Anyone telling you these scores are a hidden race proxy is misreading the report. Anyone telling you the outcomes are even has not read it at all. Here is the strongest argument on the other side, and it is genuinely strong. The scores work. That FTC report, the one Congress ordered, did not find a scam. It found that drivers with the lowest scores filed roughly 1.7 times as many property damage claims as drivers with the highest, even after stripping out every other risk factor they could measure. The correlation is real, and it has been tested by a federal agency with no stake in the answer. And there is a second thing the FTC found that almost nobody quotes. Under this system, 59% of consumers pay less than they otherwise would. Only 41% pay more. This is not a tax on everyone. It is a transfer, and most people are on the receiving end of it. If you're going to argue against this, argue against it honestly. The industry is not making up the correlation. It is using one, which leaves one question, and it is the one the entire industry cannot answer. Why? Not whether the correlation exists. It does. Why it exists. What is the mechanism that connects a missed payment on a credit card to a collision at an intersection? Nobody has produced one. Not Fair Isaac. Not the insurers. Not the FTC in 4 years of federally mandated study. The industry's own explanation, in its own words, is that analysis shows a correlation between how a person manages debt and the likelihood their policy produces losses. That is a description of the finding. It is not an explanation of it. So this is what is actually happening every time an American buys car insurance. A number is generated from your borrowing history, weighted by a formula you cannot see, to predict a behavior nobody has ever connected it to, and the result reorders what you and your neighbor pay for the same car on the same street. 4 states looked at that and said no. 43 looked at the same thing and said fine. Go back to those 2 drivers. Same city, same car, same spotless record, $900 apart. Nothing about either of them changed. What changed was which side of a line they landed on in a model neither of them was shown, measuring something neither of them was told about. That is the VIG. It was always in the price. You were just never given the number. Your credit file also decides what a car dealership charges you to borrow. That mechanism is much less subtle, and it is worth more to the dealership than the car is. That is the next one.